Okay, right. So guys, a very good afternoon to all of you. We will see for another 3 minutes time, and then guys we'll start off. Okay, today's topic: consolidated income statement. Okay, right. Now, guys, during the week 1 of revision, we looked at adjustments to financial statements. Week 2, last week, we looked at consolidated SOFP. I just feel like we need to do a little bit more of them just to get the hang of it. So today, guys, we will start off this topic first, and then let's see what we can do. Okay. And then if time permits, yes, of course, we will touch more questions on the SOFP area, right? Now, guys, today I'm planning to discuss with you all what you can say. Consolidated income statement. Okay, that's the one that we are planning to discuss today. Consolidated income statement. Okay. Right. Now, guys, first things first. How do we start off a consolidated income statement? Now, first of all, guys, remember, for you to understand consolidated income statement, first you need to have an understanding on consolidated SOFP, as the mechanisms and the adjustments are similar. Same thing. We just bring the knowledge forward into this part. Now, when you talk about a consolidated income statement, when you start the question, the very first thing that you need to do is understanding the group structure. So, guys, you need to figure out who bought whom, at what percentage, how much is left for the NCI. So you need to, figure all those out. So rather than question number 10, let me see, guys, whether there is an easier question where we can start off with, and then we'll move to the tough ones. Okay. Yeah, let's start off, guys, with this particular question over here. Right, plate and saucer. Hope you can see the screen clearly. So this is the question. So this is what they have asked us to do, right? The requirement. Okay. Now, guys, always when you start a question, first see the structure. Who bought whom? Okay. So in this question, guys, they are telling plate acquired 70% of saucer on 1 January 2001. So what happened, guys, again? Plate acquired 70% of saucer on 1 Jan 2001. Okay. So what you do, guys? First thing, you set up the structure. Setting up the structure means you try to understand in your mind, okay, who bought whom? Plate acquired whom, guys? Saucer, how much percent? 70%. That means, guys, how much percent is left? 30% is left. That is what we call NCI, non-controlling interest. Right. Now, guys, there's another one thing that you should decide when you start a consolidated income statement is that when did the acquisition take place? Now, guys, see, this question is finishing in December 2004. Plate acquired 70% of saucer on 1 January 2001. It's a long time back. Question is for 2004. The company was bought in 2001, 3 years ago. So understand, guys, if the company was bought several years ago. Now, first you need to understand this part. Now, the question is finishing on 31st of December 2004, right? So if the question, guys, finishes off on 31st of December 2004, right? If the question finishes off on 31st of December 2004, the question starts on 1st of January 2004. Normally, guys, accounting is 12 months, no? So it has started 12 months prior. Okay, now, guys, understand this point. If the company was bought on the first day, or if it had been bought before this, we consider it as a full year subsidiary. Is that clear? Once again, guys, first you read the question and see when is the question finishing. Then you have to figure out when is the question starting. The important part is that when you figure out when is the question starting, if the company was bought, if P had acquired this on 1 January 2004, or if the company had been bought, guys, way before this, then we consider it to be a full year subsidiary. You had it with them for the entire year. So meaning you don't have to worry much. Now, the next question that I'm going to revise, it's a mid-year acquisition. What's the meaning of mid-year acquisition? The company was bought within the current timeline. So then I'll teach you what to do. So guys, from this, what you should understand is that if the company has been bought at the start of the financial year, or if it had been bought way before this, then there is nothing that you have to worry. It's a full year subsidiary. So let me just make this point, guys, over here. This is a full year subsidiary. So guys, remember all these questions, what I'm practicing, I have shared it in the Telegram group on the first week. Okay. Just check and see, guys, there might be a document in the name of this F3 FA exam kit. So from that is where I'm practicing all my questions. First week, second week, third week, everything, guys, was practiced to that itself. Okay, so just little bit check on that and see. Right now, guys, we understand that this is a full year subsidiary. Now that you have, guys, figured that this is the full year subsidiary, now let's start copying the numbers first into the format. Okay, so over here, guys, revenue. So normally, guys, what you should do is this. For those who have not done consolidation with me, step is where you understand the structure. What is step 2? Copy. Copy what? All income and expenses of the parent and subsidiary, you copy it and show. In other words, we need to consolidate. That means we need to add parent income with the subsidiary income. Parent expenses with the subsidiary expenses. We need to combine it. We need to consolidate it. So this is how, guys, the consolidation part would be done. Okay, right. So just have a look at this one, guys. Okay, revenue. So guys, revenue is going to be 1,500 plus 700. Cost of sale. Now, cost of sale, they are telling item number 1. Let's ignore item number 1 for the time being. Normally, how will I do? 775 plus 370. Gross profit, not needed here, guys, not applicable. Administration expenses. Okay, so administration expenses, 317 plus 135. Right. Then, guys, we have operating profit. So operating profit paper says no need. Interest receivable. Okay, let me, guys, show that one. That's 15. Finance cost. It says item number 2. Just ignore that for the time being. Right. I'll just show you how to do it properly. 60 plus 20. Profit before taxation, not needed. Income tax expense, they are asking, okay, 96 plus 45. Profit after tax, not applicable. So this is what, guys, you have to do when you start a question. Okay, so again, guys, quick recap what you have to do once again. Step number 1, set up the structure. Understand whether it's a full year or a mid-year acquisition. Once you understand that, start consolidating line by line. In simple words, take the parent income, add with subsidiary income. Take the parent expenses, add with subsidiary expenses, and show. Now is where we are going to learn the adjustments related to our consolidated income statement. Can you guys little bit quickly check and let me know, guys, any doubts that you have until this point for me to clarify and then go to the next part, right? Check and see, guys. Are you okay with what I have done so far? Don't worry, I'll be doing at least 3 questions on income statement today. And then after the break, I will pick up SOFPs as well. Right. So please do ask me, guys, any doubts what you have, guys, until this point. Please check and let me know. Okay, so guys, doesn't seem like anyone is having any doubts so far. If there is, just send it. Okay, right. And next one, guys. Now, guys, listen. If an income statement comes for your exam, I can guarantee you that this adjustment is going to come 100% sure. Okay. In an income statement, one of the guaranteed adjustments that you can get in your exam is this. What is this? Intra-group sales and purchases. Intra-group sales and purchases means one company is selling goods to another company. That's what we call intra-group sale and purchases. And don't forget, intra-group sale and purchase will always be coupled up with URP. What's URP, guys? I taught you all last week. Unrealized profit. So what is unrealized profit? That's where, guys, one company sells products to another company and they keep a profit. And these products are still inside the warehouse. It's not sold. Let's say, guys, A sold to B some products, and those products B was not able to sell to the customer. B still has these stocks inside his inventory. This is what we call unrealized profit. So guys, remember once again what I said carefully. If income statement does come for the exam, these two adjustments are 100% guarantee. What are the two adjustments? Intra-group sale and purchase. One company sells products to another company. Second adjustment is what, guys? URP, unrealized profit, where the stocks are left and we need to calculate the profit on that. So now, guys, let me teach you how to do the two adjustments what I spoke about. What is the first adjustment? Intra-group sales and purchase. One company sells to another company. So, guys, look at this one. During the year, saucer is subsidiary, sold goods to plate for 150. So, subsidiary sold goods to parent. You know, guys, what you should do? Eliminate. Okay, you need to remove this. So, how to remove this one? Think. Subsidiary sold. That means for subsidiary, this is sales. So you go to sales and remove this answer and show from our sales minus 150. Then sales will become debit. When I remove this, sales becomes debit. Now, subsidiary is selling, no? Then parent is buying. So when parent is buying, for parent, this becomes a purchase. For him, it's a purchaser. So therefore, guys, you go to cost of sale and reduce 150 from that. Why are we reducing from cost of sale? Simple. Guys, now you can see, normally purchasers is inside cost of sales, no, in accounting. So you want to remove, that's why minus. So then what will happen? Cost of sale becomes credit or purchasers becomes credit. This is all what you need to do if subsidiary is selling goods to parent or vice versa. Even if parent is selling goods to subsidiary, same thing you should do. What you should do? For one company, it's a sale, remove from sales. Sales becomes debit. For one company, it's a purchase, remove that from cost of sale. So therefore, guys, what will happen? Cost of sale also will become credit. This is the double entry for intra-group sales and purchase. Very simple. For one company sale, remove from sales. So one company purchases, remove from cost of sales. Simple as that. That is all what you need to do. So if you're having a doubt on this one, guys, just let me know. Right, second one. Then, guys, remember I said you always our exam has two things. One is this intra-group sale and purchase. What is the other thing, guys? URP, unrealized profit. Here, see. 1/5 of the goods remained in the inventory. See, guys, I told you, no, right? One company sold goods to another company by keeping a 20% profit. And from these sales, some are left inside the warehouse, some are left inside the inventory. This is what we call unrealized profit. Okay, that is what we call, guys, unrealized profit. So now, guys, let me teach you how to calculate unrealized profit quickly. Now, last class, I gave you a formula. What's the formula? Profit multiplied by inventory held. So how to calculate profit? Normally, guys, profit is equal to selling price minus cost. Okay. Right. Now read this and see. Sources sold goods to plate for 150, making a profit markup. Okay, now guys, listen carefully. In accounting, when someone uses markup, we assume the cost as 100%. That's something I think you would have been taught in your theory class. If the organization is using a markup, we guys assume the cost is 100%. The profit is 20%. From where did we get 20%? Here, guys, markup of 20% means that's the profit. So, guys, now see, it's basic math. 20% profit, no? Cost is 100%, no? That means selling price has to be, guys, how much percent in that case? If the profit is 20 and the cost is 100, selling price has to be how much, guys? 120%. So, you need to work out your percentages this way. Is that clear? Right. Now, guys, once you have worked out your percentages, guys, that way, now let's start doing the calculation. Okay. So now, guys, the paper is telling Saucer sold goods for 150. Sold mean that's selling price. So I'll mark it here. 150,000. So you know now what you should do. Start calculating, guys. 150,000 is represented by 120%. Divide by 120 and multiply by 20. Why are we multiplying by 20? What's the reason? Guys, for the URP, what do I want? Profit. So the profit is 20%, right? That's why I'm trying to calculate 20% and take. Right now, guys, can you little bit check and see, guys, over there? 150,000 divided by 120 multiplied by 20. So therefore, guys, I'm getting the answer as 25,000. That's my profit. Let's put it now over here. Profit is 25,000. Multiply this by inventory held. 1/5 is remaining inside the inventory. Divide by 1/5. Then the answer will be 5,000. All good? Right. Now, guys, listen very carefully. This 5,000 is the URP. Is that clear? 5,000 is what? URP. Right. Now, guys, listen very carefully. In our exam, it doesn't matter who sold to whom. It can be subsidiary selling to parent. It can be parent selling to subsidiary. In the income statement, once you get your URP, always go and add this to cost of sale plus 5,000. This is all what you need to do. Add 5,000. That's it. Understood? Once again, guys, I know you might be thinking, why? I will explain that part. Don't worry. Just listen, guys, over here. Remember, in income statement, doesn't matter if parent sells, doesn't matter if the subsidiary sells. Once you get your URP, just go and add to cost of sale. Now I'm going to teach you why are we adding to cost of sale. It's, guys, because of this reason. The reason why we are adding this to cost of sale is because, see, in accounting, last Monday I taught you, if parent sell to subsidiary, okay, if parent is selling to subsidiary, the double entry for URP in accounting is, guys, inventory becomes credit and retained earning becomes debit. Okay. So this is the double entry and the parent is selling to subsidiary, guys, related to URP. Likewise, if the subsidiary is selling to parent, what is the double entry for URP in accounting? The double entry will be like this. Inventory, credit, then I'll guys little bit shift it over here, then that will be easier for you to see. Right. Inventory credit, retained earnings debit, percentage. What is this percentage? According to the parent percentage. And NCI debit percentage according to this percentage. Right. Now, guys, listen. It's like this. When parent is selling to subsidiary, retained earning becomes debit. No, we are ignoring retained earning becomes debit. The reason why we are ignoring retained earning becomes debit is because, guys, understand, retained earnings we are not showing inside the income statement. No. Retained earning is in the SOFP, not inside the income statement. So therefore, we are not worried about the debit entry. When subsidiary is selling to parent, retained earning debit, we are not getting involved. NCI debit, we are not getting involved. Why? When the retained earning becomes debit, when the NCI becomes debit, that's an impact to the SOFP. So we are not going to be worried about that. Right now, guys, look at this. The key point. Inventory becomes credit. Okay, now, guys, understand or listen carefully. It's quite confusing. Inventory becomes credit means closing stock is reducing in accounting. Is that clear? When the inventory becomes credit, that means, guys, inventory is dropping. Inventory is reducing. Why? Inventory is an asset, no? When the asset becomes credit, asset is reducing. So when the asset reduces, closing stock will go down. When the closing stock goes down, cost of sale goes up. That's why, guys, we are going and adding to cost of sale. Now you must be thinking, when the inventory is going down, how can the cost of sale go up? Don't worry, I'll show you an example. Okay, but just understand, guys, these things. Okay, so again, coming back to everything what I have said so far, guys, listen once again. Once you get your URP, doesn't matter if the parent is selling, doesn't matter if subsidiary is selling. Once you get your URP, please go and add to cost of sale. Why are we adding to cost of sale? Because look at the double entry. In the double entry, the debit part is not relevant because that impacts the SOFP. The credit part, closing stock is affecting cost of sale. Closing stock is inside cost of sale, no guys. So understand, when the closing stock is credit, stock is reducing. When the stock is reducing, cost of sale goes up, and that's why we are adding 5 to cost of sale. I'll show you proof. Okay, guys, look at this for an example. Will you see? Opening stock is 100. Purchase is 500. And closing stock is 300. Then, guys, what will be the cost of sale answer? Then cost of sale will be how much? 100 plus 500 is 600. 600 minus 300. Cost of sale is 300. Okay, same example. Opening stock is 100. Purchase is 500. Closing stock is 100. Okay. Guys, now this is the thing that I want you to focus. Closing stock earlier 300. Now closing stock is 100. So closing stock is reducing. Now, guys, can you tell me then if the closing stock is 100, what should be the cost of sale? Cost of sale will be 600. How 600? 100 plus 500 is 600. Sorry, my bad. 600 minus 100, guys. Answer will become 5. Okay. So that will be your answer. Okay. Answer, guys, will become 500. Now, guys, did you notice this? I wanted you to understand. See, look at this, guys. When the stock is going down, when the closing stock from 300 became 100, when the closing stock went down, what happened to the cost of sale answer? Cost of sale answer went up. Can you see? Same concept. When the inventory becomes credit, closing stock is reducing. Just like this. When the closing stock is reducing, cost of sale will go up. Here, guys, 300 became 500. That's why I'm adding the URP to the cost of sale. All good? So this is what, guys, you should do. So I went so long because I wanted you to understand the theory. Understand the logic. Don't just memorize. Okay, see, learn how it works. So, guys, summary is this. When you get a URP, what you have to always do? You should add it to cost of sale, no matter who sells to whom. Parent seller, subsidiary seller, doesn't matter. No matter who sells, just get your URP. Please go and add that inside your cost of sale. Simple as that. Why are we adding to cost of sale? Because in the accounting double entry, inventory is becoming credit. That means stock is reducing. So when the stock is reducing, cost of sale will increase. That's why we are going and adding this inside cost of sale. This is the explanation for the URP. Right. Okay. Now, guys, can you look at the last one, guys, over here? Roman number 3. Something new. Now, guys, listen. This one will always come in the exam. Okay. In the A-level, like, sorry, not A-level. In the FA exams, income statement, guys, this Roman number 2 will always come. Definitely it will come. No doubts. Right. Roman number 3. Sometimes it will come. Sometimes this will not come. Right. Can you guys quickly read Roman number 3? And just give me a minute, guys. I'll quickly bring myself a bottle of water. Okay, right. Now guys, look at Roman number 3, something new. On 1st of October 2004. So once again, guys, remember the date is important. On 1st of October 2004 means our question is finishing in December, no guys. That means when you count October 2004, November 2004, December 2004. So guys, there is 3 months. Understood? October 2004, November 2004, December 2004, guys, there are 3 months. Okay. So what happened? Plate, who is the parent, gave a loan to Saucer for 6%. Okay, so 1 million loan into 6% annual. But guys, now we itself understood, no? Has 1 year gone? No, right? From here to here, has 1 year finished? No. So guys, October, November, December means there are only 3 months, no? So therefore, what you do, multiply by 3 and divide that by 12. So therefore, guys, our interest will be then 15,000. This is the interest. All okay? Take the loan, put the interest, see the months. If 1 year, leave it at 6%. But 1 year has not gone, no guys. Can you see October, November, December, just 3 months. So the interest is 15,000. Now what to do with this interest? Guys, now can you see? This is a transaction happening between parent and subsidiary. When transactions happen between parent and subsidiary, we call them as intra-group transactions. Bottom line, you should eliminate all intra-group transactions. Okay. Once again, guys, when transactions happen between parent and subsidiary, we have to always eliminate them. If not, it will result in double counting the same thing. Okay, so like guys, this sales. Now see, when one person is selling to another person, we are eliminating that transaction. No, same concept. Here, when Plate is making a loan, now think in Plate's point of view. Plate is giving a loan. So for Plate, he will get interest. Understood? Once again, Plate gave a loan. So guys, if someone gives a loan, they will receive interest. No? So that's where guys over here, they have shown interest receivable. So what you have to do? Remove it. Why? Because it's happening between parent and subsidiary intra-group transactions. So therefore, guys, from my answer sheet over here, I'm now going to remove 15. Done. Now think other party's point of view. Now, guys, Plate gave to Saucer. Now think this in Saucer's point of view. Saucer is getting a loan. If Saucer gets a loan, what he should do? He has to pay interest. If he has to pay interest means paying interest is a finance expense. So therefore, guys, what you should do, go to finance expenses and remove 15. Just like the first one. Now, guys, over there, guys, what happened? Wait, guys, 1 minute. Yes, sure. I will explain that one. Okay, right. So, guys, for the others, so yeah, just like the second paragraph, for one company, it's a sale. So, guys, we removed it from there. No? For one company, it's a purchase. No? So, I removed it from there. Same like that, guys, this interest part over here, for one company, they are getting interest. So, therefore, what you should do? Consider this as interest receivable and remove that from there. Whereas for the other company, they are paying interest. So therefore, guys, because they are paying interest, for them, it's a finance expense. So therefore, you go and remove from finance cost. So this is how, guys, you have to do the third adjustment. Right. So, guys, once again, I think there are students who had difficulty with the third adjustment. Now, third adjustment, what happened was this. Parent gave a loan to Saucer. So they want us to calculate the interest. So what I did was, I took the 1 million loan. They are charging 6% interest. So I put 6%, but this is the catch. The loan was given in October 2004. No, our question is finishing in December 2004. So can you see? October 2004 to December 2004, there isn't a year. There is only 3 months. That's why the interest I have seen for 3 divided by 12. Okay. 1 million into 6%, that's the interest annually, no? But the interest should has, the interest now has been incurred just for 3 months. So that's why I am saying the answer into 3/12, which is 15,000. That's how I got 15,000. Next thing what you should do is that you need to eliminate this from our records. Why? Because it's happening between parent and subsidiary, So we call this as an intra-group transaction, just like the sale and purchase where we removed from both parties. Same like that, this interest also for one company, it will become interest received because one company gave the loan, so they will get interest. So remove that from interest income. One company is going to pay the interest. When they are paying the interest, that's the finance expense. That's why we are removing from finance expense 15. That is how the third adjustment needs to be done. Now, guys, listen, like this, there are so many types of adjustments in our exam. Okay, I think, guys, if I'm not wrong, I would have shared a short note in the TRG group regarding income statement. If I haven't shared, then guys, I will share it with you all. Wait, guys, let me little bit check and see, guys, over there. Have I consolidation short note? No, income statement short note, guys, I haven't sent you. Wait, guys, I'll share it with you. Right. So guys, now I'm sharing a document with you guys. Now this document will have whatever that I explained now. How to start an income statement, how to do the adjustments, right? Like this, there are 2 more adjustments that can come in the exam. That is also there, not that it can come in the exam, but it's just a hypothetical situation that can happen. So that also, guys, I have shared in my short note. So that short note explains for you what is the adjustment, what is the double entry, whether to add or whether to subtract. Everything is included in my short note, guys. Now I'll share it with you all in the group, so you all can access that and see. Right. Done, guys. I have shared a short note, and also it has a lot of answers, workings and everything. So if you study this for the exam and go for income statement, guys, that should be more than enough over there. Done. Okay. Right. So that is how, guys, you have to do that last adjustment, guys, over there, Roman number 3. Okay, right. So now, guys, let me teach you how to finish off an income statement. Right. Okay. Now, guys, what you should do, now you start totaling it up. Okay. So when you guys start totaling it up, what will happen? 1,500 plus 700 minus 150. Here, guys, the answer is 2,050. Right. That's revenue answer, 2050. Cost of sale, guys, it says item number 1. So item number 1 means, guys, we have to select 775 plus 370 minus 150 plus 5. So 775 plus 370 minus 150 plus 5. So it has to be, guys, Roman number 2. So when you select Roman number 2 in your exam, this will get updated. And guys, remember, cost of sale, we have to subtract. Expense, no? Right, administration expenses, guys, then you can add and mark that 317 plus 135, which is 452. Where, guys, the answer is that also subtract. Expense, no? Right, interest, guys, once we update, the answer will become 0 dash. Finance cost, guys, 60 plus 20. Okay, that's item number 2. So, guys, item number 2, what does it say? 60 plus 20 minus 15. 60 plus 20 minus 15. So it has to be Roman number 3. Now, guys, it's 15, no? How did we get 15? Like this, no? 1 million into 6% into 3/12. 1 million into 6% into 3/12. It has to be minus. So when you select this, answer will be okay, and subtract expense. Then, guys, over here, income tax 96 plus 45. So therefore, guys, the answer will be 141. Okay. Then the answer will be for that one, subtract expense. Right. So guys, that's it then from this page. Next one, guys, it says item number 3, where we have to go to the next page and see. Right. So I have, guys, completed the whole question and given it to you. Just check and see, guys, doubts that you're having, because I want to answer this one, item number 3. So for me to, guys, answer this one, I should go to the next page. So therefore, guys, just check and let me know, guys, are you having any doubts on this particular area, what I have taught you so far? Okay, right. So guys, since there is no questions being asked, let me, guys, then move to the next page. Non-controlling interest, how to calculate that? It is okay, this one over here. Right. Now, guys, normally, how do we calculate non-controlling interest, guys? There's an equation. So that equation is in my short note, but I have shared it in the group. So normally, guys, to calculate NCI profit, this is the equation, guys, that we normally go for. It has to be, guys, Roman number 1. This has to be the correct answer. So they're just asking, guys, the equation. So the equation is Roman number 1. Check the short note, guys, which I shared to the group. It has that. That's it. That is all, guys, what you need to understand for income statement, consolidated income. So this one is, guys, associate. So later, I will explain to you all what is an associate towards the end of the class. And over here, guys, you just have to calculate simple ratios for plate and saucer. Okay, simple ratios. You don't know, guys, accounting ratios. You do the formula, you get your answer. That's it. So this has nothing to do with consolidation. You just apply the ratio and get your answer. That's it. Okay, it has nothing to do with consolidation. Right. So, guys, another one question we'll do on consolidation, and then I'll give you one for you to try on your own. Right. Let's have a look at, guys, this particular question over here. Right. This one, guys, called Patty and Selma. Right. Now, guys, can you do a small work for me? I want you to read Roman number 1. Can you decide in your mind, or maybe if you're noting these down in a book somewhere, can you, guys, write and show me who bought whom? What percentage? When? Is it a full year? Is it a number of months subsidiary? Right. Decide that one, guys, quickly first. Okay. Read the first paragraph and decide that one, please. I want you to do the group structure and show it to me. Okay, right. So guys, can I explain? So the group structure. Okay, right. So guys, it's like this. Patty acquired 70% of Selma on 1st of May 2001. Okay, so guys, structure. Parent acquired 70% of Selma. So guys, that was on when? 1st of May. Okay, now guys, understand this one. Our question is finishing on 31st of December 2001. So then figure out, okay, 31st of December 2001 is when the question is finishing. No? So if the question finishes on this date, it should start on 1/1/2001. Okay. If the question finishes off in December, it has to start in January. Now guys, look at this part. If the question starts on January, now read and see. Yeah, they acquired on 1st of May. Now guys, see, they acquired on 1st of May 2001. Now in the earlier question, they bought way before this. But in the current question, they have bought on 1st of May 2001. 1st of May 2001 is somewhere in the middle. After the year has started only, guys, they have gone and bought this particular asset. Sorry, they have gone and bought the particular company. After the financial year starts only, guys, they have bought. So when if you buy the company after the financial year, okay, if you buy the company, guys, after the financial year, we call this as a mid-year acquisition. Got it? If you buy the company at the start, no problem. If you buy the company after the year starts, then we call this as a mid-year acquisition. So guys, from here to here, how many months are there? May, June, July, August, September, October, November, December. So this is a 8-month subsidiary question. Now, last time it was a full year. This is a 8-month question. So if you understand that it's a 8-month question, you know what you should do. Again, start copying everything in your paper. Copying everything means add, consolidate, like this. Here, guys, look at the screen. Right, revenue, 987 plus 567. Cost of sale, though it says item number 1, let me show you. 564 plus 336. Gross profit, no need. Administration expenses, 223 plus 123. Operating profit, no need. Finance cost. So finance cost, guys, it will be 50 plus 30. Right. Profit before taxation, no need. Income tax expense, start marking that one, guys. 40 plus 24. Profit after tax is not needed. Owner's profit is not needed. This is not needed. But guys, listen carefully. Now, unlike the earlier question, this is not a full year subsidiary, no, guys. This is a how many month subsidiary? This is a 8-month subsidiary. So therefore, what you should do for subsidiaries values, you should mark 8/12. Because guys, 567 is the answer for 1 year, no? So divide by 12. You own them only for 8 months, right? So multiply by 8. Here also, guys, same thing. 336 into 8/12. Here also same. 123 into 8/12. Here also, guys, same. 30 into 8/12. Here also, guys, same. 24 into 8/12. In simple words, for all the subsidiary income and expenses, you need to mark the number of months. The number of months that they acquired, you have to, guys, mark it and show over here for if it is a question where you have bought them after the financial year starts. That's it. That is all what you should do. Apart from that, there is no big adjustment. It's just that you have to mark everything into 8/12 because you own them for that much only this time. Okay, unlike the earlier question. So this is how, guys, you have to start off when the question is being bought midway. Right. Now, guys, what I want you to do, can you guys try to do this particular adjustment on your own, Roman number 2? So how you have to do Roman number 2? Like this. In Roman number 2, there are 2 things. Intra-group, sale and purchase. First do that. Like how I taught you last time, or maybe in your mind, can you just think, okay, this is what should I do? This is what I have to do. Second thing, guys, this one has a URP. Can you guys try to calculate the URP also, and try to, guys, can you adjust over here and show it to me? Okay. Try to adjust the URP also and try to mark it over here and show. That's what you have to do. All good. So read the paragraph. There are two things. Can you guys try this and see, please? Okay, right. So guys, little bit check the first one. During the post-acquisition period, what does that mean? After the company was bought, Patty, who is the parent, sold goods to Selma for 120. So guys, what happened there? Patty sold goods to Selma. So guys, if Patty is selling to Selma, what has to happen? For Patty, this is sales, no? So you go to sales and remove this and show minus 120. Sales will become debit. Okay. Just like last time, guys, doesn't matter who is selling. From sales, you remove. So sales will become debit. Now, for one company, sales means for Selma, it will be what, guys? It will be purchasers. So purchasers is inside cost of sale. No, remove this from cost of sale. Cost of sale will become credit. Done. That's it. Revenue will become debit. Cost of sale will become credit. That's your answer. All good? Right. Then, guys, let's move to the next part. Now, guys, I said, always in the exam, after this, what's the next adjustment? It will always be what, guys? URP, unrealized profit. Now, guys, let's learn how to calculate unrealized profit quickly. So URP is equal to what, guys? Profit multiplied by inventory held. Okay. Right, let's start. Profit. So normally, guys, profit is equal to selling price minus cost. So in our question, markup of 20. So profit is 20. Okay. Markup of 20 means profit is 20. Guys, like last time, if it is a markup, the cost is there, no, guys. The cost is always 100%. That's something that you should memorize. Okay. If it is markup, cost is 100%. No doubts. Then selling price has to be the missing answer, which is 120%. Then you know, guys, you'll get the answer. 120 minus 100 is 20. Okay. Now, guys, what they are telling? Sold for 120. Sold for 120 means this has to be the selling price. Okay. Sold for 120 means this has to be the selling price. Okay. Now, guys, let's start. Now work out. 120,000 divided by 120. Divide by this. Now we want profit, no? So multiply by 20. So therefore, guys, when we multiply by 20, our answer would be 120,000 divided by 120, that into 20, where the answer is 20,000 rupees. Now take 20,000 and, guys, put it here. Multiply this by inventory held. How much is held? 1/4 remained inside the inventory. See, guys, 1/4 remained. 1/4 remained means 1/4. Okay, divide that and take the answer. 20,000 multiplied by 1 divided by 4. Answer is 5,000. Okay. Guys, like I explained to you last class. Oh, sorry, not last class. Like I explained to you guys in the previous question. Remember, what is this URP? If there is a URP, what should we always do? If there is a URP, guys, what should we always do? We have to always add this to cost of sale. Okay, we need to always add this to cost of sale and show. So once again, guys, quick recap, doesn't matter who sold to whom. Now, last question, subsidiary sold to parent. Now, parent sold to subsidiary. It doesn't matter who sells to whom. Under the double entry, inventory becomes credit. When the inventory becomes credit, cost of sale will go up. Okay. When the inventory becomes credit, inventory reduces, cost of sale will go up. So when cost of sale goes up, it's always plus. So just keep things simple for you. When there is a URP, what should you always do? Add this to cost of sale. It's as simple as that. That's it. Right, now guys, let us now quickly start calculating these values, and then I can give you a question for you to try on your own. Right, so therefore guys, 987 plus 567 into 8 divided by 12 minus 120. So guys, listen, when you put these numbers in the calculator, don't go to change anything. Just put it like that itself. Now, even see, I'm calculating guys over here. Just put the entire thing on your calculator. Don't need to put bracket, don't need to change anything. Just type the entire thing. Okay, so you'll get the correct answer. So therefore, guys, for sales, I'm getting 1245. Right, this one, guys, item number 1. Let's see what is item number 1. 564 plus 336 into 8 over 12 minus 120 plus 5. 564. This is okay. Minus 120. Okay. Plus 5. So it has to be, guys, what? Roman number 3. That has to be the correct answer. Subtract. So when you do this, answer will get updated. Right. Next one, guys. Administration expenses. Let's calculate that one, guys. 223 plus 123 into 8 divided by 12. So therefore, guys, the answer is 305. So the answer is subtract. Why? Because it's expense. Next one, guys, finance cost, item number 2. Answer, guys, should be this. You see, 50 plus 30 into 8 over 12. 50 plus 30 into 8 over 12. And that was subtract. Right. Then, guys, income tax, 40 plus 24 into 8 divided by 12. Answer is 56. That's it, guys. Not applicable, not applicable, not applicable. Item number 3. So again, guys, item number 3 is in the next page. So therefore, guys, we'll see what they're asking. Right, can you guys little bit check and see, are you guys okay with what I have done over here? Any doubts that you want to clarify before we move to the next page? Please ask me, guys. I'll explain. Okay, all good, guys. Let's go to the next page then. Okay. Now, guys, when you go to the next page, guys, again, guys, same story, right? Again, same story. They are just asking from you guys once again, what is the formula to calculate NCI profit? Okay, what is the formula to calculate NCI profit? So, guys, normally formula to calculate NCI profit will be like this. First, you should take the NCI percentage. Then you should multiply by subsidiaries profit after tax, not before tax. Okay. You have to multiply with subsidiaries profit after tax. So after tax is here. See, after tax, into 8 over 12. Guys, why into 8 over 12? Because subsidiary was bought for 8 months, no? So 8 over 12. So that part is okay. And minus NCI share of the unrealized profit. So therefore, guys, this has to be the answer for Roman number 2. Again, guys, understand this one, little bit of a theory question. I need to teach you associates. Over here, guys, task number 3, understand, guys, this is ratio. Now, usually, guys, students have a little bit of an issue when it comes to this. Guys, I'll tell you one small thing. When they ask you to calculate ratio, look at this, guys. Using the individual entity financial statements. Individual entity means don't think about consolidation. Don't look at the consolidation numbers. By looking at the individual entity financial statement, do the ratio gross profit and operating profit for both the companies. That one, guys, we have to do it like this. Right, let's go to the previous page now. Okay, now guys, when I go to the previous page, what they are asking is like this. They are asking you to calculate gross profit ratio. What's gross profit ratio? Gross profit divided by revenue into 100%. Correct or wrong? Right. Then guys, on the other hand, what's the next ratio? Operating profit. What is operating profit formula? Operating profit divided by revenue into 100. All okay? So guys, what you should do is this. If it is petty, for the first one, gross profit is 423, revenue is 987. For Selma, gross profit is 231, revenue is 567. If it is operating profit, for Patty it's 200, for Selma it's 108, revenue is this. Now guys, can you see the adjustments, Roman number 1, 2, 3, I never considered. Parent subsidiary consolidation, I never considered. So when they ask ratio, don't think about the consolidation or the adjustments. Just pick up the numbers from the income statement like how I did now and just find your answer, substitute and find your answer, guys. Simple as that. So don't complicate ratios. It's always done for single company, not for consolidation. Consolidation ratios are in the next level, financial reporting, not at foundation or financial accounting level. Okay, so this is how, guys, you have to do the entire question on this part. So on this ratio part, guys, if you have a doubt, if you have any clarification that you want to make, please ask me. Right. Okay. If not, guys, now let's quickly now move to the next question. I'll give you something to try on your own. You give me the answer and then we can check and see what we can do next. Okay. So some of these questions, guys, we did last class also. Okay. Right. Now, guys, let me copy for you a question over here. So it's a big question, guys. I will just give you the adjustments related to the income statement only. Right. Okay. So guys, what I have given in red is the question. Okay. So I want you guys to now read this part, this one, this one, and also guys over here, the adjustment. And can you guys try to do these two, guys, on your own? Roman number 1 and sorry, letter A and letter B. Can you guys try to do that? Let me go for a single page view. Okay. Can you please try and show for me, guys, by looking at what's given in red over here? Try to do, guys, A and B. I'll give you roughly around, guys, let's say 3 to 5 minutes. Can you guys little bit check and see whether you can do A and B, guys, for me faster? Okay. Shima, right. Let me check on your answers. Data. First one. Yeah, Shima, both are correct. Good. Okay, right. So guys, I'll now start to explain the question. Then you can check and see whether you got it correct or where you went wrong. Okay, so guys, number one over here. On 1st October 2007. Now, first of all, guys, see when is the question finishing? Statement of profit and loss on 30th of September 2008. So 30th of September 2008 is when the question is finishing, no guys. That means the question has to start on 1 October 2007, which is the same date as when the company is being bought. Can you see? Company was bought on October 2007. This also is starting on October 2007. So it's the exact same date. So that's good. So meaning from here to here, we have 1 year. 1 year means we have, this is a full year subsidiary. Got it? So from here to here, guys, 1 full year there, no. So this is a full year subsidiary, 1 full year. So then we don't have to worry about the number of months. That's 6 over 12, 4 over 12, that and all, no need to worry. Okay, now guys, first one. Sales made by one company, 6 million. So that's easy now, guys. When you make a sale, so normally, guys, what you should do is this. During consolidation, sales or revenue, push plus shove, parent plus subsidiary. Cost of sale, parent plus subsidiary. Okay, now do the adjustment. So guys, what happened? One company sold. So when one company sells, remove from one company's sales, remove from revenue, remove from another company's cost of sale, which is purchases. like this is where you have to do the first one. Remove from sales, and also guys over there, remove from cost of sales. All good. So that's the answer for the first part. Then they made a markup of 20% on these sales. One quarter is remaining. So guys, URP. So how to do URP? URP is equal to profit multiplied by inventory held. So profit is equal to selling price minus cost. So therefore, guys, remember profit is 20%. Yeah, good. That's correct, Umayma. Right. Then, guys, over here, this part. So selling price, guys, answer is how much? Selling price answer 120%, and the cost is 100%. Right. So why is the cost 100%? Because guys, it's a markup, no guys. So markup is 100%. So sales is 6 million. So sales is 6 million means guys, selling price is 6 million. So what you do? Take 6 million, okay? Divide by 120%, multiply by 20. We are multiplying by 20 because we want the profit. So therefore, guys, the answer will be 6 million divided by 120 into 20. Answer is 1000. So 1000 will become URP. Right. Divide the whole thing. Sorry, my bad. 1000 will become the profit. Multiply this one by inventory held. So guys, how much is the inventory held? 1 quarter. Okay, so 1 quarter is remaining. So thousands 1 quarter, guys, will be 250. Now guys, I have explained to you very clearly, when you get the URP, what you have to do? You have to add it. Add it to where? Cost of sales. So therefore, guys, what we are going to do, go to cost of sales and add it over here, plus 250. This is what you need to do. Done. So therefore, guys, based on this one, yes, once again, Umayma, second one answer is also correct. Good. So over here, guys, your answers are going to be like this. Revenue, 85 plus 42 minus 6, which is Roman number 1. Cost of sales, 63 plus 32 minus 6 plus 250, which is Roman number 2. These are your answers. Right. Can you guys little bit check and see, guys, whether things are okay with you? And let me know, guys, for any doubts that you have on this area. Okay. So guys, in that case now, guys, what we can do is let's go for a short 20-minute break. And once we come back, guys, we will continue with more questions. Okay, right. So now, guys, 7:25. So, right. Can you guys come back at 7:45 then? Then we'll resume the class. Okay. Okay, right. Now, guys, from the cute book which I sent you all have guys completed all the questions, right? Everything is done. So now, guys, only what is left is so I have now, guys, found a question related to consolidated income statement. So this is the question, guys, which I found from the CBE specimen exam. So when you directly just go to Google and if you type ACCA CBE mock exams or specimen exams, you will get this. It's accessible to everyone. It's on the ACCA website. You can get this. Right. So let's check and see, guys, the question what they have asked. Right. So we'll try to do this one, guys, together. Okay. Can you guys quickly read this part over here and see faster? Okay. So first of all, guys, you read this. Got it? So once you read this, I want you to decide the group structure. And once you have done with the group structure, we'll see what is the other questions that they're asking. Okay, right. First of all, guys, can you quickly go through this part and guys decide the group structure? I'll give you a minute time. Okay, so in this question, guys, they're telling Keswick acquired 80% of the share capital on 1st June 2005. The summarized profit and loss is given below. So, guys, remember, if the question is finishing on 1st of May, sorry, if the question is finishing on 31st of May 2006, the question, guys, should start on, right? So when should the question start? 1st of June 2005, which is exactly, right, which is exactly the date in which the company was bought. Okay, 1st of June 2005 is, guys, exactly the date where the company was bought. So like again, this is the full year subsidiary. Right. Now, guys, that we know that it's a fully a subsidiary, in your mind, can you guys quickly work out this particular adjustment, guys, for me faster? Okay. Please go through this part and try to work out, guys, this adjustment for me. Okay, done guys. So what's happening guys over here? Now this is actually easy when compared to things what we did in before the break. See guys, during the year, Keswick sold 1 million worth goods to D for 1.5 million. So this is selling price. Okay, 1.5 million guys over here is the selling price. So because 1.5 million is selling price, this is the intra-group sale and purchase. So normally guys, what we should do with intra-group sale and purchase, step number 1, we should remove from revenue, remove from sales. Second thing guys, what we should do, we should remove from cost of sales. So like this guys, I hope in your mind, you were able to make up this answer. Or guys, you can even, right? But load this in your laptop or something and you can start doing it with me because this is available for you readily. Okay, this particular question. Right. Then guys, what happened? 30% of the goods remained inside the inventory. Okay, that's guys URP. Now it's slightly different. Now you should understand guys, what's the URP formula? Profit into inventory held. Correct or wrong? Okay. Profit into inventory held. Okay. Now guys, when you take this URP formula, see, unlike the earlier questions, we don't have this markup margin story. They haven't given markup or anything. So you have to get the profit. It's quite easy, guys. Profit is 500,000. How did we get 500,000? Read carefully, guys. Sold goods costing 1 million for 1.5 million. So we are making a 500,000 profit. On 31st, 30% of these goods remained in the inventory. So multiply this one, guys, by 30%. So once you multiply by 30%, guys, answer has to be 150,000 when it comes to URP. So as we all know, normally guys with URP, what we should do? You should add it to cost of sales. So guys, you mark it over there plus 150. So this is how guys you have to do the two adjustments what is given over here. So now that we know the answers, now let's start selecting it guys one by one over there. Right? Can you guys a little bit check and see with this 1.5 million and 150, are you all okay guys? Any doubts that you have? Okay, right. So guys, no doubts. Right. Now guys, let's go down and start selecting the answers for the question. Okay, right. Okay. Okay. Now guys, over here, first thing, right. Can you guys quickly make up the right. They have given you 4 options. They are asking you the topic. These are guys basics of accounting, right? Okay. Can you guys quickly select the topic for me faster? Just you can decide for yourself. Okay, then that's easy. Okay. So guys, have you all decided the answer for the first one? So obviously guys, now what are we going to do over here? We are going to do a consolidated income statement, correct or wrong? Okay, so we are going to do a consolidated income statement or consolidated profit and loss. Now you all guys should understand profit and loss is always done for the year ended. It's the SOFP, we do it for asset. So obviously it's a consolidated. So option is number 1, no number 3. So guys, out of these two options, you have to understand profit and loss is always done for the year. As at is normally for whom, guys? As at is normally for the statement of financial position. So therefore, the answer has to be the first one, guys, over here. Done. Right here, you can see, guys, our marks have got updated immediately. Right now, guys, let's go to the next one, revenue. Okay. So guys, one more time, can you quickly decide, guys, revenue, what has to be the answer, because they are giving us some options, right? Okay, can you quickly make it in your mind? Normally, how should the revenue be? Like whether it's plus so, whether it's minus so, right? Can you guys quickly decide that on your own? Okay, right. So guys, how to do the revenue? 8,400 plus 3,200 minus 1,500. Okay, let's select that answer, guys, over there, right? 8,400 plus 3,200 minus 1,500. Done. So you got not marks. Right, next one, guys, cost of sale. Can you guys quickly check the cost of sale working? Sorry, guys, I have to go up and down because the numbers are not visible from here. Okay, right. Right, decide your answer, guys, for cost of sale also quickly. Done. So guys, normally cost of sale, how to do? 4,600 plus 1,700 minus this plus this. Okay, so let's select that option also, guys, quickly. Right. So that's going to be 4,600 plus 1,700 minus 1,500 and plus 30% of 150. That's correct. No, guys, how did we get 150? 500's 30%. So this has to be the answer. Correct. Right. Then guys, next one, gross profit. So guys, here, can you see? They are asking us to type the gross profit answer. Now, whereas in the exam kit, right, in our textbook questions, they did, or the exam kit question, they never asked the gross profit. Okay, so now we have to, guys, calculate gross profit. So normally, guys, gross profit is how? Sales minus cost of sale. Okay, let me guys quickly mark the answer then over there. Sales minus cost of sale. So 8,400. So first let me get the cost of sale answer. 4,600 plus 1,700 minus 1,500 plus 150. So 4,950. So 8,400 plus 3,200 minus 1,500 minus 4,950. So guys, I am getting 5,150 as my gross profit. Okay, 5,150. But little bit check and see, guys, is that answer correct or is there anything wrong, guys, over there? 8,400 plus 3,200 minus 1,500. 4,600 plus 1,700 minus 1,500 plus 150. Yeah, the answer is correct, guys. 5,150. Okay, then guys, distribution cost. The working is not. Yeah, actually, for this part, guys, which one? For this one, guys, what I did was like this. I just updated my answers and only took, okay, 5,150. Right? I just only, guys, updated. So here, guys, you all have to update this part and take. I mean, I did not show, guys, any working over there. Right. Right. So next one, guys, distribution cost. So distribution cost, guys, how should we get the answer? Distribution cost is 1,500 plus 510. No, distribution cost is 1,500 plus 510. So the answer will be how much, guys? 2,010. Administration expenses, guys, how should the answer be? 700 plus 450. So that will be 1,150. Okay, let me, guys, write those two answers down faster. 2,010 plus 1,150. Okay, 2,010 plus 1,150. Done. Okay, then, guys, we have to calculate profit before tax. So normally, guys, how do we calculate profit before tax? Gross profit minus distribution expense minus administration expense, you will get the profit before tax. 5,150 minus 2,010 minus 1150. So therefore, guys, I'm getting 1990. Right. Sorry. Okay. Then, guys, next part, we have taxation. Right. Let's go up and see, guys. Tax is how 600 plus 140. So 600 plus 140, guys, tax has to be 740. Right. Let me mark that one. Tax is 740. Right. Okay. Now, guys, once the tax is 740, guys, profit for the year. So normally, guys, how do you get profit for the year? Profit before tax, which is 1990 minus taxation, which is 740. Where, guys, the answer is 1250. Done. Okay. Then, guys, next part, attributable to the equity owners of Keswick. Okay. So normally, guys, how do we get the Keswick? So who is Keswick, guys, in this question? Keswick is whom? The parent. Usually, guys, how do we get the parent answer? We usually take this profit. Okay, now though this was not tested in the other questions, I'll now teach you. Profit is there now, guys. Now this 1250 is whose profit? Group. Group means what? Parent profit plus subsidiary profit. Both profits together is 1250. So normally, guys, what we do, from this profit, we remove NCI share. Understood? This is whose profit? Parent profit plus subsidiary profit. So inside this, there is a portion that does not belong to Keswick. So the portion that does not belong to Keswick is the NCI profit. So normally, guys, what we do in accounting, from this answer, we remove whose profit? The NCI profit. So this is the group profit. From the group profit, guys, we have to remove the NCI profit. Then you will be able to get the correct answer for the parent's share of profit. Okay. Next one, guys. NCI interest. Now, in the question that I have done from the book, they never ask for the answer. What did they always ask? For the formula. Right now, guys, normally what's the formula for the NCI profit? Normally, guys, formula for the NCI profit is like this. NCI percentage into subsidiaries profit after tax. From this, we should subtract URP. Okay, into the NCI percentage. But guys, listen very carefully. URP you should adjust only if the subsidiary is the seller. Understood? Now, this is the equation that we normally use for FA. In the non-controlling interest profit, we take the NCI percentage multiplied by the profit after tax of subsidiary, and we have to remove the NCI share of URP. But listen very carefully. You should remove the NCI profit for URP, or my bad, you have to remove the NCI profit, guys, only if the subsidiary is the seller, not when the parent is a seller. Why is that? Guys, understand, when the parent is selling, what's a double entry in accounting? When the parent is selling, what's a double entry for URP? Inventory credit, retain earning debit. So can you see? I said a double entry now. What's a double entry, guys? Inventory credit, retain earning debit. Meaning, can you see in the double entry, NCI is not involved. So understand, when the parent is selling to the subsidiary, the URP doesn't affect the NCI. That's why here I'm being very specific. But when the subsidiary is the seller, what's a double entry for URP we studied last week? When the subsidiary is the seller, guys, double entry is inventory credit, retain earning debit, NCI debit. There the NCI is getting affected. So bottom line, when in questions there is a URP, make sure that the subsidiary is seller. Because when the parent sells to subsidiary, and if there is a URP, NCI does not get affected. NCI is not involved. But when the subsidiary is selling goods to the parent, then when there is a URP, yes, of course, the NCI is getting adjusted or it's getting affected. So please understand, guys, when I say URP, it has to be subsidiary is the seller. because then only NCI gets affected. Not when the parent is seller. When the parent is a seller, there is no impact on NCI. So now guys, let's try to do this equation what I have shown over here. Let's start. Let's go up. Right, first thing we need NCI percentage. So guys, in our question, what's the NCI percentage? Keswick acquired 80. So if Keswick guys has acquired 80, how much is left then? 20% is left. So 20% multiplied by subsidiary's profit after tax. Subsidiary is debent, no guys. His profit after tax is 400. So the answer will be for that one, 80. Minus URP. Guys, now read this question. During the year, Keswick sold to Derwent. Keswick is parent. Parent has sold to subsidiary. So guys, if the parent is selling to subsidiary, here the URP does not affect the NCI. So the answer is 0. See guys, there is a URP of 150, but I am not going to consider it at all. Why is that? Because this one doesn't affect my NCI. But let's say for an example, it was Derwent, who is the subsidiary, had sold this to parent. Let's assume it that way for the purpose of learning. So Derwent had sold to Keswick. Subsidiary has sold to parent. Then guys, you know what I will do? Then I will take this URP, right? 150, this one. And I will put the NCI percentage, which is 20%. Then it will be 30. So then my answer will be 50. This one you should do when who is the seller? When the subsidiary had sold, then you will do like this. Take the URP, put the NCI percentage. But today's question, guys, it's not the subsidiary who sold, no, guys, it's the parent. That means URP is not there. So final answer is 80. So therefore, guys, now let me go and mark this 80 down in our answer sheet. So therefore, guys, non-controlling interest answer is 80. Done. That's it. Okay, now guys, see, 11 out of 11. Everything what we have marked is correct. So this is how, guys, your exam paper also will be. I don't think it would be any different. But can you guys little bit check and see any doubts that you have, guys, on what I have done so far? Little bit see. Okay. Is it the NCI profit calculation or is it the URP part, guys? Okay. Okay. Now, guys, over here, when it comes to this part, which is, guys, the URP impact on SOFP, guys, I covered it last week during that one. So little bit check that part and see, guys, normally when it comes to SOFP, the URP impact is different. That one, guys, last week we discussed on that one. Just check on the SOFP recording, right? Okay, anyway, this one, guys, over here, how to calculate the NCI interest, guys, this is the formula that you have to go for, right? NCI percentage multiplied by subsidiary's profit after tax. Because normally, guys, remember, NCI can get a profit from subsidiary company. Now here, guys, we have two companies, no? So NCI can get a profit from subsidiary company. So therefore, guys, only from subsidiaries company profit only you can get an NCI share. So what you have to do is like this. Out of these two, guys, subsidiaries Derwent, take his profit from this 20% will go to NCI. How 20%, guys? 80% is what they bought, no? So 20% is remaining. So 20% of 400 is 80. Then from this, for this level, we have to only remove URP. But you have to be careful. You remove URP only if who is the seller? Only if the subsidiary is seller. Right? Only if the subsidiary is seller, we have to remove that from the URP. So in our case, it was parent who sold, no? then this URP doesn't affect the NCI. Okay. If the parent is selling the product, then the URP will not affect our NCI. That's why I put 0. But if subsidiary had sold, in our question, if Derwent had sold to Keswick, what I will do is I will take the URP, put a percentage, because guys, now we are doing NCI, so the entire thing can't take. We should only take NCI percentage. So I will be taking only the NCI percentage over here, and I will be subtracting it. But in our case, it was not that way. So I just took 80 over there. Right. Last week, I think last week one might be available in YouTube, because normally what they do is every week, once the TRJ class is over, they will upload this in YouTube, because it's streaming in YouTube also. So last class, if you little bit check the recording and see, from start to scratch, I would have explained the SOFP. So little bit check YouTube and see, because every week, if I'm not wrong, they upload the TRJ session in YouTube. So go to PPIM YouTube channel and you will be able to find that. Okay. All right. Okay. Now, guys, over here, this part, guys, does the existence... Okay. Now, guys, let me quickly explain to you what's the relationship between parent, subsidiary, and associate. Because I think, guys, that is something that you need to understand carefully, to answer questions like these. Okay. To answer questions like these, to answer theory questions, you would always need that. Right. Okay. Right. Now, guys, remember, what is the difference between an associate and a subsidiary? Now, guys, subsidiary means a company that we have control. Okay. Subsidiary means a company that we have control. What is meaning of control? You are going and buying more than 50% of the company. Okay. More than 50% of the shares you're going and buying. That's what we call a subsidiary. So subsidiary, guys, you can control. You can control means you're only making the decisions. Associate, on the other hand, we call it, guys, as a company that we have influence. Understood? What is associate? It is where, guys, we assume the company we have influence. Having influence in the sense, it's like this. The percentage is between 20 to 50%. So, guys, when you buy a company between 20% to 50%, such company is what we call whom? Associate. What is the ownership percentage between 20 to 50%? Got it? Right. Now, guys, you need to understand, in an associate, we only have influence. What is only have influence means? Only have influence means like this, guys. When the decisions are being taken, we can tell our suggestions. Okay, we can tell this is better. We can do it like this. We can give suggestions, but we can't make the final decision. We can tell our idea. We can try to, change the decision, but final call is not ours. But in a subsidiary, not like that. Subsidiary, what we say only final decision. We control. But influence means, guys, we can give our input. We can give a suggestion, but final call is not ours. So that is what we call influence. We can just tell what we want, but we can't make the final judgment. Then, guys, we have something called investment. Something less than 20% if you own, we call it an investment. So investment, you can't do anything. You just put your money and stay. Right. Now, guys, remember over here, if it is a subsidiary, the method of accounting is called consolidation. What is consolidation? In the SOFP, guys, what we do? Assets we add, liability we add. For the equity, we have some workings, right? Goodwill working, non-controlling interest working, retained earning working, like we have some workings what we looked at last week. Whereas guys, if it's and if it comes to the income statement, you know what we did today. Take the income, add with the income. Take the expense, add with the expense. Like that, we have some workings. That's what we call consolidation. Whereas guys, when you take an associate, the method of accounting is called equity method of accounting. Equity method of accounting means first we take the investment. Guys, listen, in your exam, they won't ask you to calculate associates. Associate, you just have to know theory. Calculation part won't come. Calculation part is coming means the calculation part will come in the next level, financial reporting, FR, not now. So at this level, you just need to know theory. So equity method of accounting means we take the investment at the post-acquisition profits. So guys, remember, for an associate, unlike subsidiary, we don't add their assets and liabilities or income and expenses. Now, subsidiary, guys, you saw how we did, no? Assets, we always combine with our assets. Liability, you always combine with liability. Income, we always combine with income. Expenses, we always combine with expenses. But associate, we never do it like that. Their assets and liabilities, we don't combine with our assets and liabilities. It's not ours because we have only influence, not control. Their income and expenses won't become our income and expenses. We can't combine it that way. So guys, understand, for associate, we do a small working. Okay. What is the working? You don't need to worry about it at this level. Right? For the associate, when it comes to the SOFP, we do a small working. One formula you will learn in the next level. For the income statement also, there is an equation. That also you will be learning in the next level. So for associate, we will be doing that SOFP related working, and that answer what we get, we will go and mark it under non-current assets. So normally guys, in the SOFP non-current asset, first we have PPE. After that one guys, we have goodwill. No, below goodwill, you will write and show investment from associate, and you will show that answer. Understood? For the associate, for the SOFP, there is an equation. You will do the equation, take the final answer, copy it here and show. That's it. Nothing else we are doing. We are not adding the assets and liabilities like how we do for a subsidiary. Likewise, guys, when it comes to the income statement also, there is a working. We will be doing that working. Once you do that working, what you are going to do, you will show it over here. Now, guys, in accounting, there is something called this one, no, guys, finance cost, no, right? So below the finance cost, we will be showing over here profit share from associate, or sometimes people show this below other income. Anything is okay. Below profit finance cost, we will be showing guys over here profit share of associate. So for the income statement also, guys, we'll do an equation. That final answer, we'll show it over here on the consolidated income statement. That's it. We don't add their income and expenses like how we do for a subsidiary. So this is what guys you need to learn when it comes to an associate. Right? So associate means guys, we have influence. That means you can tell your recommendations, but final call is not yours. Percentage is 20 to 50. Method of accounting is equity method, meaning you take the investment at your post-acquisition result. In other words, you're not adding their assets and liabilities, income and expenses like how we do for a subsidiary. We just do two simple equations. The equations answers, we are going and marking it in the SOFP and income statement like this. So this is what guys you need to learn in terms of an associate. So for the FA level, you will only get theory questions related to our associate, whereas guys it is in the next level where you will be getting questions on this particular part. Okay. Okay, now guys, if possible, can you guys little bit try to decide what are the answers guys for this one? So read the question and try to pick up the answer guys for this one, please. Okay, right. Done, guys. So they are asking which of the following factors illustrate an existence of a relationship between parent and subsidiary. So only subsidiary and parent. Control, yes. 100% of the equity shares being held by an investor. Guys, you go and buy 100% of a company. So will that become your subsidiary? Yes or no? What do you think? Answer is yes. If you go and buy 100%, guys, you are controlling them, no? So therefore, that is also yes. Greater than 50% of the preference share and debt being held by an investor. Okay, now guys, understand. Normally, for you to gain control, you have to buy ordinary shares, not preference shares. Understood? If you want to invest, if you want to make someone your subsidiary, you have to buy ordinary shares. Why? Ordinary share only has voting power, not preference share. Preference share doesn't have voting power. Okay, so therefore this one, even though it's 50%, guys, it has to be ordinary share, not preference share. So here, guys, the answer is no. Okay, right. Next one. Significant influence. No, guys, significant influence is whom? Associate. Okay, so therefore that is not subsidiary. Right, 50% of all debt being held by an investor. No, guys, that has to be ordinary share. You have to buy ordinary share, not debt, not preference share. Greater than 50% of preference share. No, guys, it has to be ordinary share. Greater than 50% of the equity share. Yes, that's correct. And then, guys, last one, non-controlling interest is 10%. Guys, think and see, if non-controlling is 10% means you have bought how much percent? 90%. So that means you have control, right? So therefore that is yes. So here, guys, 4 out of 4, all the answers are correct. Right? So these are things, guys, that you need to know of companies. Okay, so just check and let me know, guys, if you have doubt on this area. If not, we can move to another one question for today. Okay. Okay, right. And also, guys, I just want to make a small request to you all, because if you all do this and come next week class, it will help me to do, or it will help me to, guys, practice more questions. Let me just show you over here. Okay, right. So, guys, I think I'm having a very slow connection in my laptop. Let me just check in my phone. Okay, right now, guys, since it's not loading in my laptop, the YouTube, I want you to guys to do a small work for me, because if you can watch this particular uh, video and come for class next week, it will help me to accelerate and do more questions with you. So guys, what you should do is this, right? You go to YouTube, then guys, you have the PPIM YouTube channel. So in that YouTube channel, guys, I want you to go to ACCA FA Revision, right? Game plan 01, which was done 3 months ago. Okay. So in this particular recording, which was done 3 months ago. Okay, don't go for this time game plan number 1, because you all were, that is your batch. Okay, you all were with me on the first day, right? So go to the one, guys, which was done 3 months ago. So in that 3 month one on the first day, I have explained to students about cash flow indirect method, the basics. Plus, I also did with them, if I am not wrong, 2 or 3 questions fully from the exam kit I did with them. So during the next week, if you can just go through this particular recording and come, then we can practice new questions on cash flow, like the one over here. Now, here in this exam platform, there is a cash flow question which I would like to discuss with you all, like this. So then that would give me time to do this, and also, guys, practice more questions with you all from different areas. So if you can, guys, go through this and come, then next class I will be able to load a new question on cash flow and help you practice that. So that's your homework, guys, for next week. Just go through this and come. It will help you to, if you're already okay with cash flows, then no problem. If you want another support on cash flow indirect method, please watch that. I'm explaining the basics, doing all the questions and showing you how it's done. So please go through that part over there. It will be very helpful for you for the next class. Okay, so that's your homework for the week, because next week is the last revision class for FA. Okay, anyway, guys, regardless, right now, let us, since we have, guys, around 25 minutes remaining, one more question we will do, and then we will conclude for today. Let's check and see, guys, which question. Let me exit the exam. Okay. Okay. So, guys, now this is the question on what you can say SOFP. Okay. This is the question on SOFP. Right. So, right. Right. Now, guys, if possible, can you guys try to get me the answer for this part, guys, over here? If you can you little bit try to do the first part and show it to me? Calculation of goodwill. So this is what, guys, we did last class now. I'm seeing how I can show the whole thing for you. This one, guys, we can't minimize also now. Let's see whether I can copy paste this question to another window. Right. So, guys, I have copy pasted the question to you on a new page. So if possible, guys, can a little bit try to do this question and help me get the values for this part, guys, over here. Right. So this is your data. They're asking you how to calculate goodwill. What are the numbers that we need? Okay, I will, guys, give you a small hint. In this, you have to prepare working number 2. Okay, so I want you to go through this question. It's easy. It looks scary, to be very honest. There's so much of things they're asking. But guys, if you read very carefully, they're asking the same things what we practiced last Monday. So what I want you to do is I'm going to give you 5 minutes time. Prepare working number one, which is the group structure, and working number two. What is working number two? Net assets of subsidiary. Prepare that. If you can prepare that one, guys, you will be easily able to get the answers for all these what they are asking. Got it? 5 minutes time. Right. Start this question, guys, for me. Okay, right. So guys, were you able to find some of the values for this? Okay. Now guys, see, I ask you all to do two workings. What are the two workings what I requested you all to do? First one, I wanted you all to do working number one, which is the group structure, right? So normally guys, how do we set the group structure? So on 1st of January 2003, the question is 2009. So several years ago, which is a good thing. So G acquired 75% of whom? E. So that means guys, there is a 25% subsidiary. So 25% NCI. Okay. Now guys, working number two. Normally how working number two goes like this. Net assets of subsidiary. So we have guys like this some columns. First we have details. Then we have at the acquisition date. Then we have reporting date. And then we have PAR. So guys, what is PAR? PAR means post acquisition reserves. Now this is how I taught you know guys last class. Net assets. Net assets means this one, the capital, right? Net assets, right? So the net assets are what and what? We have the equity, share, and retained earnings. So now guys, read the paragraph and see. On 1st of January 2, and also guys, remember the values what you see over here. Okay, the values that you see over here are reporting column. Now again, focus guys. Net assets means this. Of subsidiary. ACCA is subsidiary, right? So ACCA has two values. What are these two values? We call this as the reporting date, meaning the day that we are doing the question. So therefore, guys, over here, your answer has to be this part, 1000, while this part, 660. Okay, now read the question. On 1st of January 2003, they acquired 75% for 1,380,000. For 1,380,000, this is what we call investment. So you paid 1,380. So guys, over here, this is the answer that you have to mark. Okay. How much did we invest? 1,380. That's the investment. So normally, guys, what you should do, okay, let's then go further. The retained earnings at that date was 480. So the retained earning is 480 means, guys, see, at that date means at the date of acquisition. That time the retained earning is 480. So let's mark that over here. At the date of acquisition, retained earning is 480. ACCA's share capital remain unchanged since acquisition. That means here the answer and this answer is same. I thought I said you guys last Monday also, right? I said you that, but at this level and in the next level, the shares don't change. It's always same. And here they itself have said you. Right. And the draft financial statements has been given. So now they have given you everything. Now guys, remember one small thing. When you write investment here in the goodwill working, make sure you remove this from your paper, 1,380. Got it? Once again, when you write investment inside the goodwill working, that particular amount you have to remove from the SOFP investment. So I have removed it from here. Investment credit, goodwill becomes debit. Then everything, guys, they have given non-controlling interest. Non-controlling interest, guys, should be marked to goodwill. Normally, after the investment, what is the next thing that we have? After the investment, next thing we have to add this one, guys, here. NCI at the acquisition date. That is what we have to add. So here they have given the NCI at the acquisition date was 450. So the answer is 450. Like this, you have to mark it and show. Okay. Then guys, total value of investment at acquisition. Then I think guys, they're asking you to add these two answers and show. So that will be guys 1,380 plus 450, which is 1,830. Done. The value of ACCA's net assets at the acquisition date. Equity share capital answer is 1,000. From where did I get this 1,000 guys here? Fair value of ACCA's net assets at the acquisition date. See, net assets, acquisition date, equity share is 1,000. So I put 1,000. So after that one guys, what do we have? Retained earnings. So select that. So what was the answer? 480. Select that also. Right. Then guys, total fair value of net assets at the acquisition date, 1,480. How did we get 1,480 here guys? Total fair value at the net assets is 1,480 at these two. Then guys, goodwill. So normally, guys, goodwill should be like this. Goodwill should normally be this one minus this one, A minus B. Okay. Normally, goodwill is this one minus this one. So A minus B, do we have an answer that way? A minus 100% of B. So normally, guys, when it comes to goodwill, we don't put the percentages. A answer minus B answer. So A answer minus 100% of B's answer. So that's how, guys, we are going to get. So here, guys, you can see, right? Full mark. 4.5 out of 4.5. Everything we have got the answer. Right. And normally, guys, remember in the exam, what you should do, like if you are doing the whole thing, 1000 to 1000, guys, there is no changes at all. 480 to 660, guys, there's a small change. How much is the change? 480 minus 660. Where the answer is 180. So this 180, guys, what do we call this? Post-acquisition reserve. Can you guys remember this 180? You should give it to parent and to NCI. Right. Giving it to parent and NCI in the sense, okay, giving it to parent and NCI in the sense like this. From 180, 75%, which is the parent's proportion, should be marked in working number for retained earnings. Normally, guys, this 180 comes from retained earnings. Now, so parent share, you have to mark in parent's retained earnings. This NCI share, which is 25%, that 25%, guys, should be gone to the NCI working. Like this, you have to mark your answer and show. Okay, right. So this is how, guys, normally the answer is split. I mean, when we do the full question, it's easy. When they ask MCQ question, it's difficult because we have to keep everything in mind. Right, let's go to the down part, guys. What are they asking? Right. Right. Let's move to the next part now. Here, guys, see. Select the formula which correctly states NCI at the acquisition date in accordance with IFRS 10. So normally, guys, how to calculate the value of NCI? First thing what you need now, just check and see, guys, our last class work. I have given you some formulas, or even check the short note which I have sent to the TRG group. That's normally how do we calculate NCI? First, you need what? Fair value of NCI. Okay, so fair value of NCI. So these two are our options. Then, guys, to this we normally add what? Post acquisition reserve. So here, guys, see, post acquisition reserve 180, but the NCI is only going to get how much? The NCI is only going to get 25% of that. So therefore, guys, answer has to be this. This should be the correct answer. So normally how to calculate NCI, guys? We take the fair value of NCI. Okay. To that, we have to add PAR, post acquisition reserve, not the whole thing, only NCI share. That's why I took this as the answer. Right. These two are, guys, incorrect. We don't add the closing answer. You have to add the post acquisition answer. Right. Then, guys, let's go down. Now, guys, they are asking from you answers like these. Okay. Now they are asking you to tell the value. Okay. They want the value of these. Investment, guys, my answer is going to be 0. Why the answer is 0? Here, guys, look at this. From 1380, I cancel 1380 now because I took it to goodwill. So therefore, the answer is 0. That last class, I, pressed on this point and I explained to you all because I know that questions like these comes. See, guys, normally investment from the question, you should remove what you marked in goodwill. So in goodwill also we marked, no, so that's why I have removed. So the answer is 0. Right. Other assets. Guys, normally in consolidation, guys, how do we do assets? Assets are normally parent and subsidiary add together. So once you add together, you can mark the answer over here. Share capital. Normally, guys, in the SOFP, we only have whose share capital? Normally in the SOFP, we only have parent share capital. Only this you have to mark and show. Only parent share capital should come. Retain earning. So normally, guys, remember for retain earning and non-controlling interest, unfortunately, you should do the working. There is no other option. What we did last class. So normally guys, for retained earning, what's the equation? We go like this: working number for retained earnings. Normally we start with brought forward of parent. So what is the brought forward of parent guys here? Now see these retained earning, no, go to retained earning. He's the parent, no, what's the answer? 2040. So mark that. Plus post acquisition reserve. Post acquisition reserve means here guys you have 180, no, parent will get 75%, no. So how much is 75% guys of that one? 180 into 75%, answer will be guys 135. Add these both, you will have your answer. That's it. But you need to know the equation, memorize it. Okay. So brought forward of parent, which is 2040, to this guys post acquisition reserve, meaning 180 is parent share. NCI. Now we already discussed, no guys, normally how to calculate the value of NCI in the SOFP. NCI will be fair value of NCI, which is here 450 plus post acquisition reserve, where guys the answer is going to be 45. How did we get the answer as 45? Listen guys, take 180, give the NCI share. Got it? Take the answer, give the NCI share 45. So once you add, you have your answer over here. Okay, last part, liabilities. So normally guys, how do we find the answer for liabilities in consolidation? Adding. So therefore guys, liability means add these two together and show your answer. This is how guys you have to do the question. So remember guys, my advice is that please go through last Monday's work. For each working number 1, working number 2, working number 3, 4, 5, there are some equations what I gave. No, start by hearting them. Because guys, now see in the exam, you're not allowed to draw anything, right? So therefore guys, you need to remember the equation of each of those workings. Now actually guys, for this one, URP also will come. This one also URP will come. So like this, you need to know the equation, start memorizing, so that when they ask questions like these, you jot down the equation first and then start finding the numbers accordingly. Then your FA exams will become easier. But you need to study the equation for each of the working over there. Right. So guys, then with that one, we have done a proper revision on income statement plus SOFP guys. So I think consolidation guys, we can conclude at this point. So next week guys, don't forget what's that recording income. So I'll be able to discuss cash flow and maybe, you know, practice some MCQs from various parts of the syllabus. All right guys, so that's it then for today. I'll see you guys again next Monday at the same time for the final revision class.